I have a confession to make. Last year was one of my worst years in terms of trading. I didn't lose much, but I broke my own rules, and in general, I lacked the consistency I previously had. I don't want another year of mixed results, so after extensive reflection and analysis, I've made some decisions and came up with a realistic plan to get back on track. This might help you too. Let me walk through the 10 specific steps I will concentrate on. This year, no more day trading for me. Instead, all of my trades will be swing trades. I know day trading seems attractive because it allows you to fit more trades into each session, but last year I realized most of my losing trades were in fact day trades. Many studies have shown that day trading has a lower probability of long-term success. The constant noise makes it quite challenging to achieve consistent profits, especially if you are a beginner. The lower timeframes where day trading takes place are like a battlefield dominated by algos and other high-frequency traders. They have more firepower and are able to take advantage of those small price movements that retail traders often miss out on. This year, I'll shift my focus to swing trading, holding trades for several days on the daily and weekly charts. It aligns better with my goals as a trader by reducing unforced errors and considering the bigger picture instead of just monitoring short-term fluctuations. So this year, no more obsessively staring at lower charts, waiting for a signal. Moving forward, my rule is to exit all positions within a minimum of 2 to 3 days, unless there are unexpected events. I plan to give my setups the space they need to unfold without arbitrary restrictions. Instead of reacting to every trading opportunity, I will focus on several reliable, high-probability setups that I can consistently read and execute. So to achieve consistent results, I will master only a few techniques involving the volume-weighted average price, the VWAP, reading order flow and volume imbalances, and identifying key zones from the daily and weekly pivots. These are my A-list trades that have proven to be effective in my backtesting. While other ideas may seem alluring, these specific factors have consistently resulted in a 60% win rate over years of backtesting when carefully traded. Quality must trump quantity for consistent profits. So rather than blindly chasing every opportunity, I'll be selective and focus on my A-plus trades that align with my proven strategies. The truth is that after 16 years of trading, I want more time for myself. Previously, I would find myself obsessively watching charts for far too long each session, which only diluted my focus and led to poorer decisions. But now, I've made a conscious decision to limit my daily market time to just 2 hours. This intentional choice allows me to block out distractions, minimize fatigue and stress, and maintain a laser-like focus during my trading sessions. By setting this time limit, I ensure that I have enough opportunities to explore potential trades throughout the week, while avoiding the pitfalls of spending excessive hours in front of the charts. I will also use price alerts to quickly get into a trade when all my conditions are met. It's about finding the right balance. You know that staring at the screen all day doesn't guarantee a profit. This strict time boxing also forces me to be more selective with the trades I choose. It pairs perfectly with my specific A-plus setup criteria, which will hopefully increase the overall quality of my trades. Instead of being reactive, I will become deliberate and strategic. If you're like me, you probably have a disorganized approach, jumping between unrelated markets based on hype rather than true conviction. But let me tell you, data has shown that focused specialization can dramatically improve trading results. Instead of being a generalist who scratches the surface of many markets, I've chosen to narrow my scope significantly. For this year, I will dramatically cut back my universe to just 10 highly liquid instruments. My core currency majors include pound dollar, pound yen, and euro yen. These are the currency pairs I will focus on the most. Alongside these, I'll also keep my eye on the Nasdaq, the S&P, the crude oil, and the mega cap stocks like Tesla, Apple, Microsoft, Amazon, and Nvidia. These are my preferred instruments. You may have others, but selecting only a few markets that I deeply understand and that have a high average daily range will hopefully provide a sufficient supply of potential daily setups while allowing much greater focus on each market's nuances. This year, zero trendline trading for me. Upon reflection, rigid trendlines lately proved more distracting than useful. In the past, I used to rely on drawing trendlines to find market trends and potential breakouts. But in today's fast-paced and volatile markets, trendlines can often lead to false signals and whipsaws. And that's why I've made the decision to no longer rely on trendlines in my trading strategies. Trendlines are the easiest to be manipulated by the smart money, leading to fake breakouts and false signals. Another reason why I ditch trendlines is because they are so subjective. Different traders can draw them in different ways, depending on their personal preferences. This can lead to confusion and disagreement among traders, making it difficult to identify reliable trendlines. In today's market, liquidity is king. It's all about understanding where the big boys, the liquidity providers, are likely standing ready to defend key levels. By analyzing order flow signals, I will try to find the zones where the market is likely to react strongly. Rather than blindly following some thin lines, I will spend my time studying and identifying key levels using the volume. These levels are where the big players are likely to make their moves. Structure defines markets, and neglecting key value areas is a major mistake. Going forward, I will only consider entries at unmitigated supply or demand zones. In the context of smart money trading, an unmitigated fresh demand zone refers to a price level in a market where there is a high level of buying interest without significant selling pressure. A fresh zone that has not yet been tested will likely offer a higher probability of a bounce. Unmitigated supply zones refer to price levels where there is a high level of selling interest without significant buying pressure. After the initial creation of this zone, price has not come back to it yet. Each time price revisits this supply zone, more and more previously unfilled orders are filled, and the level is weakened continuously. I plan to take all my trades around these zones, waiting for volume confirmation rather than forcing premature reactions around low probability levels. Another concept I will remove from my arsenal this year is the concept of fair value gaps. In theory, fair value gaps are used to detect market imbalances. For a fair value gap to develop, there must be a set of three candles characterized by heavy buying or selling in the same direction. When there is a large move in either direction, a gap will be formed between the first candle's wick and the wick of the last candle. I might be wrong, but from my experience, fair value gaps don't work consistently across different markets or timeframes. This makes them unreliable for my own style. And here's why I'll stop watching them. Fair value gaps are based on time-based charts, which don't show the order flow of the market, which is essential for understanding fair value. Fair value gaps don't take into account the volume of the trades, which is an important indicator of market liquidity, at least in my trading plan, and this can affect the validity of the fair value gaps. Not to mention there's a ton of them. You sometimes have 3 or 4 consecutive gaps, and you'll end up chasing the correct one to trade. And another thing, every time you see a wide range candle, you technically have a fair value gap. These are overrated in my opinion, and I don't really need them. Maybe as a confirmation. Maybe. They might work for you, but I prefer volume imbalances and not price imbalances. This year, I plan to take all my trades after a liquidity run. Liquidity is and will be a key factor in the markets. Think about where the liquidity is and what might drive retail traders to take certain positions. Retail traders tend to gather around certain price levels, placing their stop-loss orders and taking positions. That's why smart money are trying to strategically manipulate the market and hunt those stops. They often design sharp and aggressive moves at the boundaries of a trading range or at a major key level, inducing traders to take the wrong direction. Sometimes you are triggered by the speed of a price movement, a sudden breakout after a quiet period. You thought it was a strong breakout, but in reality, it was just a trap designed to lure you into a losing position. To avoid falling into these traps set by the smart money, I will enter only after I see a liquidity run. This is my first confirmation before entering a trade. I want to trade in line with the big boys, not against them. As an additional layer of validation before submitting my orders, I will look for bullish and bearish divergences from prices just before pulling the trigger. I will look for volume divergences or stochastic divergences when the price and the indicator are showing different signals. This technical confirmation is like a little green or red flag that tells me when momentum is getting tired and ready to reverse. By demanding this clear signal, I can weed out those pesky whipsaws that can lead to losses. It helps me avoid entering trades when the momentum is uncertain or about to change direction. And I'm aware of the lagging nature of the stochastic. I'll use it simply to provide trade ideas and insights, but it won't dictate my decisions. In my trading strategy, I'll use it as a filter that complements my core methodology based on volume and market structure. It will help me sharpen the accuracy of my trades by providing additional confirmation. At the end of the day, I believe in the power of multi-factor analysis and confluence. By demanding clear signals from different things, I optimize my strategy, and hopefully, I'll increase my chances of success. It's all about finding that sweet spot where all factors align, giving me the confidence to enter a trade. To ensure I have the right mindset each morning before trading, I have a checklist of psychology rules that I read. These rules include important reminders like not engaging in revenge trading, averaging down losses, cutting losers quickly, and ignoring outside noise. It's a good exercise to do before each trading session, just like a warm-up before a big game. By conditioning my mind with these principles, I set the stage for a disciplined approach. Controlling our emotions is just as important as any technical aspect of trading. These daily affirmations may sound silly to some, but they serve as a powerful tool to resist the pitfalls of emotions. And that's why I read them daily. Day by day, I rewire my operating system, reinforcing the importance of discipline in my trading decisions. Studies have shown that money mistakes often arise from biases rather than flawed strategies. 2 or 3 minutes each day to read your checklist isn't a lot. It simply puts you in the zone, in the right mindset to trade.